morning, everybody. This is Eric Stewart. I'm your host and thrilled to be with you. We are about to start our Coffee with Eric Stewart Timing the Market series. For those of you who heard this advertised on the radio, we would really appreciate it if you don't mind just sharing with us how you heard about this. If you heard it from the radio, put that on the like in the GoToWebinar control panel. There's a question bar that's in red. Just you heard it on the radio, or I got an email, or a friend told me. Would just really help us to know where everybody has come from today. Okay. So the purpose of our Coffee with Eric Stewart series is for me to discuss the preparation process for selling, of course, and how to hit the market right with timing, but also to discuss today where the market is within its bull market and where I think it's going and where I think it's going to land when all is said and done, okay? And I'm basing this off of 34 years of my real estate experience. I've been, again, selling homes since '87, sold over 3,700 houses in my career, and I've got a wonderful team. I'll introduce you to a few of the people that work with me in just a second that'll be on the screen. But with that time framing, '87, I got in the market, and that was right in the middle of the 85 to 90 bull market, where prices doubled in the DC region. So I saw in the middle of it, I saw how prices were going higher and experienced that in my first couple of years in the market. It was a great time to be selling real estate like it is right now. Home sellers were making a lot more money as prices continued to climb. Let me give you some relevance as we're starting our Coffee with Eric Stewart today to how prices moved then. But I'm going to go back even further. I want to go back to 1971, because it was 1971 when my mother and father decided to make a move into a community that had a house backing up to a park that a real estate agent had called them on and said, hey, this house came on, you need to see it now. They went and saw the house. They loved it. They decided they wanted to buy it. Of course, everything was different then. Information was more controlled by real estate agents, and now the information is disseminated through the internet. People know immediately through almost every channel that a house has become for sale unless it's being sold pre-market. Well, that house came up at $84,000. And my parents had purchased the home that they were in, which was a modest Kettler-built home built in the 1960s. They bought that house for I think like $44,000, $43,000. We lived there for 4 or 5 years, and it went up 30%, which again, think about that, 30% increase over a 5 or 6 year period. And they were able to sell it for 50, I think 58, 59,000. And you know, look, relatively, you know, that's a 30% rise in the value, right? In the same way that 450 rising by 30% would jump the price up to around 580, right? There's a 30% rise. So anyway, prices in the 71 were 84 grand for this house they bought. By 1980, again, during a very, very big inflationary cycle in our country, inflation really did kick in, and the cost of money actually was not cheap, though it was cheap sort of at the beginning. I think they got a 7.25% interest rate back in 71, and then rates rose as inflation kicked in, right? But still prices tripled between 71 and 80. So that same house they paid 84 is worth about 250 grand 9 years later. But let's break that down between 71, 72, 72, 73. Remember, all these years pass, and we have to remember that even now it's 2021. As prices have jumped 12 to 13% this spring, okay, as prices have jumped that much, it feels like the market's gotten too ahead of itself. But relatively speaking, going back to that era, that's only a 12 or 13% increase. It's much bigger numbers, right? If we look at that rise from up till 1980, then prices kind of stabilized and got sticky but drifted lower as rates rose up to 21 or 22% at the high. By 1987, we were 2 years into a bull market where prices were climbing 7, 8, 10, 12% each year. In 87, the market was good. In 88, it was phenomenal. It was phenomenal. We saw prices jump in 88 by 15, 18% in a lot of areas. In 1989, prices also climbed again. And in that period, we saw prices double between 85 and 90. Prices doubled. So Parents' House that was about 250 dropped to around $230,000 by about 1985. So it drifted lower, maybe 225 or so. And it then doubled to 450 to 500 by the time we got to 1990. Prices started to decrease again as we went into a recession in the DC area. 1990, we went into the Gulf War. There was a change in overall spending. The internet had not really come in to the area. This is, now in 1990, we've got George Bush as president, and this is a couple of years before Bill Clinton comes into office, and the internet, right? So this market kind of stabilized and drifted between 1990 and about 1996, and then prices slowly creeped each year 2 to 3% until we hit around 2000. And you remember 99, 2000, bull market in stocks up until March of 2000. And if any of you all invested in internet stocks, you all experienced pain like we haven't seen in a long time, right? I mean, there was a lot of folks who bought stocks that were surely going to go higher, and of course, that business, a lot of those business models just failed. Still, we saw ourselves go into a correction, and Bernanke, who was the Fed governor at the time, lowered the rates into that early 2000s. And by 2003, remember he said irrational exuberance in 2003? God, it seems like yesterday. But in 2003, he called the market in an irrational exuberance when it came to the overall market tenor and the way people were spending money, the way that real estate prices were jumping. But the rates at that time were around 6.25, which seemed really cheap. And if you got an ARM, an adjustable rate mortgage, you could do something in the 4.5% to 5% range. And so lending rules got easier and easier and easier. And I'm going somewhere and telling you this whole story because it gives you some relevance in understanding how market dynamics work. Between 2000 roughly and 2006, we saw prices on a lot of properties around the DMV, Maryland, DC, and Virginia, not only double, but triple, especially the lower priced homes, the homes that were kind of ignored in the outskirts as the wave in demand blew out, almost like how a water balloon drops and smacks the pavement and then poof, blows out and the water scatters out to the sides, right? Kind of the same thing. There was such a craziness to the market. There were places out in the Eastern Shore that were on the water that were trading for 400,000 in 1998, 99 that were now selling for 1.4 million because they had water views. There were lots available on the ocean at $105,000 in 1997 that were now trading at $850,000 by 2006. So there was an incredible dynamic and increase in pricing because money was cheap, lending was easy, and people made commitments. And of course, we know what happened in the Great Recession. There was a massive demand for money, and the banks just kept giving it and repackaging it as if it was an investment vehicle. And then, God, the whole world sort of fell apart. In that 2007, we went into that credit crisis. Countrywide went under. One bank. And then by 2008, Lehman goes out of business. And boy, that fall of 2008 was scary. I remember it's like all of a sudden, my market, which was typically more of a jumbo market, at that time that was 600 to about 1.2. That market was still vibrant, still selling and higher than that. But it was the cheaper market, the person who was working for a living on a blue collar type job that was having a hard time getting a mortgage, and that just slowly eroded the demand above it, and then the whole market just boom. By March of 2009, stock market had dropped. I think the Dow was at 6,800 or something, and here it is at 34,000. So would any of you have predicted at the end of 2009 that we would be up 500% on the Dow in the 12 years. I mean, that's really that's the increase here, 500%. And here we are. And we all feel like, I mean, I don't know about you, and I appreciate your comments here, but I don't know about you, but I feel as if like, well, God, I can't just keep going. Yeah, right. We've got to pay the piper at some point, right? We can't just keep going. And I think that fear is the same fear that I've had multiple times in my career in 34 years at different times in the market, because it feels like, no, it shouldn't keep going higher. Prices can't keep going. People cannot afford to keep paying more. And yet they did. And where are we now? My parents' house, which went to 500,000 in the 85 to 90 market, went to about a million 150 by the end of the 2006 cycle. It's not worth $2 million yet. It retraced back to being worth about $1 million at the bottom. It's now, it's just the house on that lot would sell easily, I think, at 1.3 right now. So up about 30% from where the base was. 1.3 now. That's, again, if the house was just like it was now as it was then, about 1.3. So if we're 30% in the increase, have we really seen the rise that we typically experience in this area? Is there some catalyst that's going to put a fist hand in the face of the market and say, no further, you can't go any further? I want to hear from you. I want your thoughts now. This is a conversation, and I've just talked for 8 minutes about this history, and I want to know what you think, and then I'll come back and we'll take some of those thoughts you have, and I'll form some thoughts, and we'll discuss this, because this is a conversation. I'm giving you my opinion based on my experience, but I don't know everything any more than you do, right? So let's figure it out together. I'm going to take a quick look at our questions tab here. Hey, thanks, Robin. Glad you could be here. David, thanks. James, Wayne, good. Yep. All right. And David, good, good. Thank you all. So guys, use this opportunity now to ask me questions. Based on everything I've told you now, what do you see being an obstacle to the market price rising? What are the obstacles in your opinion? And furthermore, based on what I'm saying, do you think it's possible that the house that was $1 million, say 4 years ago, and slowly creeped higher and now is up 30% from the low of the bear? You think it's going to go to 2, 2.5, 3, 5, 10 million, 1.5 million, just another, couple hundred, or stay where it is? Give me your thoughts and type those into the questions bar here in your GoToWebinar control panel. I'll come back to this and give you my closing opinions a little bit later. So I've been a realtor for a long time. This is like 34 years, 3,600 transactions. We just crossed 3,700 in the last week, so I'm grateful for that. We're at about, I guess, about 92 homes sold now. Good year for us. I mean, considering the lack of inventory, I'm so thankful. If you all are thinking about selling and you're interviewing brokers and you haven't hired us at this point, we would so appreciate you thinking about us. And it's part of the reason why I'm here today, is give you insight, also introduce you to what we do and how we work. And we would really appreciate the opportunity of being considered. We're seniors real estate specialists, which means that we work with a lot of downsizing seniors who have a lot of stuff and need to get rid of it. Dave Ramsey is I'm endorsed by Dave Ramsey, who is a nationally syndicated talk show host who talks about getting out of debt and conservative economic policies and stuff. I've been in what he calls an ELP for 13 years. And if you know Dave, I've had a chance to have dinner with Dave and be down to Franklin, Tennessee a couple times with him, and he's a great guy. Weekly radio show of my own now, 8 o'clock Sunday mornings. Gosh, guys, I used to joke about this because I would think no one would get up at 8 o'clock to listen to a radio show, but there are thousands and thousands of folks who have chosen to join me, and I'm thankful for that. and it's a half an hour. You can either listen to the show live on WMAL, or you can podcast me by having a podcast. If you know what that is, it's just a podcast is just a listening, like you can listen to a magazine, like you read one. And if you download Spotify or iHeartRadio or some other podcasting device, you'll be able to listen to my shows there. And lastly, where my heart is. So I was a theater major in college. I also studied economics, and I memorized the book of James, which is in the New Testament, and also the book of Ruth, which is in the Torah, in the Old Testament. And both of these actually talk about widows in two specific ways. In the book of James, James said, pure religion is to look out for widows and orphans in their distress. And when I memorized that in '87 and I performed it around the area as a one-man presentation, and then in 1989, I memorized Ruth and performed that at National Cathedral and other places. Again, just telling the story, speaking it out loud as it's written. Ruth and Naomi, widows caring for each other in the midst of their distress, got me thinking about not really seeing this demographic cared for, and provided a system to reach out and connect widows and widowers together through widow care, which we started in 2013. And we have a very wonderful, vibrant board. It's a 501c3 nonprofit. If you're a widow or know somebody or widower, we invite you to check us out at widowcare.org. One of our executive directors, one of the widows who was originally served by Widow Care, and we have a couple hundred every year that we have events for it online, peer support led meetings and that kind of thing. So it's a journey. We're in the process, but this is my heart on the back end of all that I do here. And thank you for that. All right, moving in. This is my team. These are the agents in my team. We're licensed in Maryland, DC, and Virginia, and provide referrals to agents outside of these states as well. So if you have a property you need to sell somewhere else or buy someplace else, we can vet a good realtor to help you. Our team's average majority of our homes is 10 days or less at 100% of list price. That's been for 5 or 6 years now. This year will be over 105% of list price, because that's where we are right now. You've heard how hot the market is, and it's kind of hard to see it until it's actually finished. The sale process is finished, meaning a buyer decides to buy a home and pay $100,000 over asking price, and now it's settled, and then the neighbors find out and go, what did that house have? The reality is the tide has risen for all the boats, and this 13% jump we've seen pretty well across the board for our home sellers. And this is this is the reality. It's like I've got a seller who was very happy to sell his home for $865,000 last year, but decided to wait. And we talked, and it was looking like 900. And by the time I put the house on the market at 935, the market was blistering hot. We had multiple offers, and we sold at $1,035,000. That's a 16% increase. Right? So not all houses are going to increase by the same amount. Demand drives interest. One we listed for $960 went to $1,160,000. One we listed for $800 went to $820. It was an all as is home. One I just closed today at $1,350,000 was listed for $1,288,000, and the seller hadn't done anything since she bought the house back in 1991 or 92. And I mean anything. I mean everything. Broken dishwasher, broken fireplace, lots of things broken. We just disclosed it all. The demand for 4 walls and a roof is driving buyers to act a little bit irrationally in order for them to make the opportunity work for them. So if you are in that place where you're thinking about selling, it's very, very important that we talk about the timing of when you sell and how you can catch the wind of the market to sell for the most amount of money. So in this market, with everybody still almost looking like this, although now it's starting to come off, and we're about to change this particular picture we've been using since last year in April, May, coronavirus brought some friction into the flywheel of timing, condition, and pricing. And we changed our consultation to video call, everybody wearing masks and booties and whatnot, and requiring sanitizer and appropriate signage. We're still going to require all of that going forward, because albeit the county is saying, hey, if you've been vaccinated, you don't have to wear a mask anymore. So people are going to be walking around without masks, whether they're vaccinated or not, in my opinion, because nobody wants to feel like they're an outcast or like they're not, ooh, they're a pariah. I think that's probably what's going to happen, because you cannot require everyone to get vaccinated. I found that out yesterday. I was looking into the details of this specifically. You cannot require it, especially for something that's not FDA approved. None of these vaccines were FDA approved, right? They were just streamlined through, and the decision was made, let's start vaccinating, okay? So once the FDA approves it, then it becomes something, I think, that can be insisted upon. I think everybody wants to know that they're not going to have an issue, but that said, as an agent for a home seller, to protect my home seller against the person who comes in, maybe or maybe doesn't wear a mask, we want to require a mask coming through our houses. Okay, so we're going to continue to do that and just say, hey, for right now, we're going to continue to make masks a requirement, and that, that people, if we do have open houses, we're having folks register before they come in the door. So we have a name, phone number, and email for anybody. So that way we can get back in touch with them if we need to. So home inspection, appraisals, all these things will be done. Split settlement. I was at settlement this morning. This was the first time the seller and the buyer were at the settlement table together since March of last year. And the title company set up a glass divider at the middle of the table, kind of like you might experience at Starbucks or other places when you walk in. If you order, they see you, you see them, but there's no, if you're breathing, it just stops there on the glass, right? So that kind of thing. And then when coronavirus came in on the timing, let's chat about how we saw that affect our median home sale price. So this particular graph shows you how the undulation, the normal rise and fall of market pricing occurs within a given year. This is the peak of May of 2018, June of 2018. The houses that settled in June of 2018 settled for the most amount of money. And then after that, when they settle in July, August, September, when they settle in July, August, and September, right here, you see how prices start to fall back because there are less buyers in the market typically when you get into July and August and even late June. This year is going to be different. There's just not enough inventory. You'll see in a minute how extraordinarily low it is. But this is the peak for 2018, and then you have this little fall market. And this is the peak for 2019, and then you have this little fall market. And this was the peak for 2020, and prices drifted all the way through the year. We didn't really have much of a fall market because prices already jumped so much. And then this is the start of this year. So this is the March and the April settlement. So houses settled in April, they actually sold for the highest amount, okay, similar to, now look, go back 1 year with me. This is April of 2020. Prices in April of 2020, those houses that went to contract in February, settled for the highest amount, even more so than the June of the previous year. So normally prices jump, and they jump a little bit further. And so this is this year's first jump, and I think by the time we get to settling in June, this is where prices will end up, which will, if you look at this cursor here, okay, and then you were to draw a line back across the tops of these years, you can see this consistency in the rise. It's not parabolic for the last 3 years, though it has picked up speed, and it did jump more. And when there is the kind of fear that I'm seeing now, it normally doesn't stop because buyers know what happened who didn't get a house this year or the year before, and they're like, I don't care what it takes. I don't care if I have to pay 150 more for the house or 200 more for the house. We've got to get a house, got to end this game. A missus who's expecting is like, honey, I'm nesting. I got to figure out, I'm going to deliver. We've got 4 kids. I got to find a house. There's a desperation that goes into some of the back end decision making. People make decisions and prices continue to rise. So we saw that price rise. We also see the days on the market. The houses that settle in May are the ones that went to contract in March. So in 2018, the May settlements, which is again the March contracts, March houses were selling in 10 days. But then the duration it took to sell a home increased throughout the rest of the year. Still not very long, 30, 33 or 34 days, the longest period on average, which would be the ones that settle in January. Therefore, they went to contract in November. So if you're selling, historically, you want to be on the market in March, April, May, June, July at kind of the latest, ideally, and then the fall market, maybe a couple months. And after that, boy, it really lengthens. Same thing last year or 2 years ago. And then last year, we saw this little rise. It wasn't much of anything. The market was so hot. The number of days it took to sell a house on average was about 8 days all year long, and this year is comparable. So we've definitely seen the speed and the number of houses on the market dropped. The baseline here is 4,000 homes. Okay, so right over here it's 4,000 houses. If I could go back in time and show you 3 years ago, we had an average of about 12,800 homes on the market back in 2015-16. Okay, up here 12,000, 13,000 homes. We saw at the peak. We've seen it drop. We saw it drop some, and then we saw this massive drop. Inventory increased. This is in real time. This is normal. So April listings, we said a lot more listings on the market in April, but most everything got gobbled up. I sold 7 homes one week, me personally, and then my team also sold. I think we sold 20 homes in a period of about 10 days. It was so hot back in the second, third week of April. And then if we move on past the active listings and look at the closed sales, and I'll close on this. This kind of, it's a little bit hard to understand how this all makes sense, but I think you guys have got it. The main thing I want you to see is the market has risen in price. There are less homes for sale. They're selling faster. And if you look last year, all we've heard about is how little inventory there is. And yet in the last year, we saw closed sales higher last year than we did the year before. And the reason is that the day-to-day positioning of new listings and then them being sold kept the inventory low, and the absorption rate was very, very fast. So it's a little bit of a surprise, because we think of inventory, well, if there's less inventory, how can more houses sell? But it's the day-to-day inventory that we're really reporting. Okay. Coronavirus, new listings fell 29% in February, steepest decline since last May, right after we were coming out of COVID a little bit. Prices were up 4% from last February. Again, this is February settlements. And that almost 4% from last February, I wouldn't rely on that, because I think it was on average 8 to 9%, but they take a median, including the most expensive houses, as well as the lowest price houses, to come up with this 4%. But the majority of homes that we're selling for 8 to 9% more that went to contract in December, and therefore were settling in February. 31.5% increase in pending sales from last March. So again, more houses selling. Prices were up 5.31 on the median. On the average, they were up 10% for the homes settling in March. We also saw a 72.4% increase in pending sales from last April, but again, last April we were shut down. And prices for homes that settled in April were up 8.48% from the April the year before, but that again was an 8.48% for contracts. Again, houses that settled last April went to contract in February. Houses that settled this April went to contract in January and February. We saw the biggest jump in pricing occur in April this year. So those are the settlements that are starting to be revealed now as we get to the end of May and we get into June. So you're going to hear news here that you're going to see, which is the prices have jumped 13%. I mean, that's just pretty much what it is right now. So, hey, we got to catch this wave. And if you're one of these surfers out here in the water, you're a homeowner, you're looking back at the wave, like, I want to catch the wave to sell my house. Like this guy, he did the same thing. He was back here where this guy on the far left was, looking for his wave. He waits for his wave, the wave starts coming in, he paddles and he catches it, right? We want to do the same thing. And so to do so, we want to look at some timing charts here to talk about that preparation process. And this is my suggested timing preparation for 90 days. And it's what we do as a group to guide our clients to understand how we work. So this again is us. It's not specifically to any broker other than us. And you'll notice that there's this red line called quiet listing here, which I'll explain separately a little bit later. This period is a period of pre-marketing that occurs before we were actually ready to go up for sale, okay? And during this initial agreement phase, for instance, I'm getting a home ready to go on the market. Now it's going to go on the market today. And 2 weeks ago, my stager walked through, gave them some final coaching on where to place furniture. There's a couple improvements that were suggested. They took care of them. Pictures were taken after they finished the decluttering and sorting. And then the photos were then proofed. We sent everything to the client. They loved it. Yesterday, the client and I talked about the price that we were going to ask for the home. This is a $750,000 single family home. And we agreed that that was the right number to ask. And I like to list a home and then discuss the price one more time before we go live, because as I mentioned to you, when you see a 13% jump in prices like I've seen, I want to bring that intelligence to my homeowner that listed with me back in January, who's finally ready, and say, hey, we got to be careful not to undersell, right? Raise that price. You would proof all the marketing, and then we would hit the market. Now, if you have questions on anything I've said so far, feel free to ask that in the GoToWebinar control panel. I've got a comment here from Wayne. Pricing may go up, but if interest rates go up, won't that put a damper on the market? Okay, let's jump back to that topic again, which is, where is the market going to go? If we think of headwinds as being like friction in the market, more expensive money, so the borrower who comes in and borrows at 3% interest is paying $4.21 per $1,000 borrowed. Let me explain how that works. If you're buying a house for $1.2 million and you put $200,000 down, you borrow $1 million, you focus on multiplying $1 million times $4.21, which would be essentially, take that, you've got $4,210 per month for 30 years to pay $1 million back. That's roughly $49,000 a year for 30 years. By the end of it, you'll have paid something to the tune of, actually, I think it's in the order of 1.5, $1.6 million, including all the interest on that, right? So you're going to pay it off over a long period of time, but you're going to pay $4,900 a month to do it. Excuse me, 1.8 million over 30 years if you don't make any additional payments. So pricing may go up, but if rates were to rise, and now let's say we're at 6%, it's hard to imagine we'll be there, but I'm going to tell you now, we will get to 6% here. It will get there. Just because there's too much demand for too little product, not just in real estate, but I think in lots of parts of our world, we're in a shortage because COVID, the production systems were down, and we've got to revamp that. So the demand is going to be there, and initially there's going to be pain, and prices will rise until there's enough production for the demand that exists, and there will be some balancing that goes on in that process. But 6% versus 3%, there's an increase from $4.21 per $1,000 to borrowed, or 4,200 bucks a month. It jumps to $6,000 a month. So even though you double the interest rate from 3 to 6, you don't increase the amount you're paying on a monthly basis by doubling it. It increases by roughly 50%, because that's how amortization works. You pay more interest over a longer period of time. You pay the mortgage back over 30 years. And in this case, at 6%, you might spend close to $2.2 million in total cost for paying back the mill that you borrowed, plus all the interest on it. So let's break that down now, okay? And this is, again, at 6%, if I were to borrow $1 million, I divide $6,000, divide that by 30 days in the month, that's $200 a day. If I take 4,210 and divide that by 30 days, that's $140. So it'll cost a buyer $140 a day to live in the house at 3%, and $220 roughly for them to live in it at 6%. How much more do you have to make in that scenario? Well, the difference between the two is about $1,800 a month. current lending guidelines say you should make about 2.5 times that. So that would imply about a $45,000 increase in overall income to afford the same house. So if a buyer were to, make, let's say, $3,700 more a month because either the employer is now paying them more or they now have more, they're able to afford the same house. I think we're going to experience a lot of home buyers who are willing to get the house, and a lot of other home buyers who are going to get shut out of the market if they don't get in on the early side. I think that even if interest rates rise, there's not enough friction in that to just shut the market down locally. What are the other potential headwinds we might face? Type those into the GoToWebinar control panel as I continue. 6-month preparation is very much like 90 days, as would a 2-week preparation be. We take the first week on the market. We like to wait 6 days. I want to exhaust the potential interest, kind of like a dam breaking with the fish all coming down from behind the dam. It's fast at first and then trickles on from there. So let's give it 6 days before we look at offers. That house I'm putting up for $750, that's exactly what we're doing. I discussed with the sellers possibly raising the price to $760, $770, whatever. But I recommended staying at $750 because it's on a fulcrum of demand. Buyers between $5 and $750 and $750 and $1 million. Buyers on both sides will find the property, and I think demand will push it higher. My hope for them is $800,000, and we'll see what happens. The quiet listing I mentioned to you earlier. Okay, this would be where we're not on the open market. There's no sign, no photos, no lockbox, no open houses. We're not in the multiple listing. We have less preparation. You might have an all as is. Maybe you got a hoarders kind of a situation, or maybe just prefer discretion. Like superstars sometimes don't want to be in the open market because they don't want people walking through their home and seeing their stuff. So they do everything on a private placement basis. Okay, so word of mouth, email through Long & Foster's brokerage. Long & Foster is the largest company. It is the largest company in the whole Mid-Atlantic. We dominate both the luxury sales, just dramatically dominate any other company you could possibly think of that says we're luxury, whatnot. They don't touch the marketing campaigns that we have through Christie's, which is the world's luxury brand. It is the luxury brand. There are other companies out there that have a luxury name or have an auction name and so on, but they're not luxury focused. They don't put a demand on what price you have to ask in order to be included. Christie's, you have to be at $1 million or higher to get all the Christie's benefits. If you're below that, we have 350 websites that we use to disseminate information, share that information. So we share information in the quiet listing with our own buyers. If it's a tear down, like we had a home in North Arlington that we went to builders on, we're allowed to solicit buyers directly or within our brokerage. And if you're going to sell this way, there's no better company than Long & Foster because of its size, the number of agents. The next closest agency in terms of number of agents has under 1,000 realtors, okay? So we're 12 times as large. Much greater chance to actually accomplish the sale this way. We vet buyers, make sure their credit is good, financial information sheet. Why would I ask for a financial information sheet? So a buyer comes in, they've got a lender letter from a local bank that says their credit's checked, there's nothing that could negatively affect their ability to purchase. Sounds good. But the buyer also could represent something to the lender that's not exactly true if they're not fully approved yet. So if I have a financial information sheet where the buyer says, this is what I do, this is where I work, this is what I make, this is how much I have in assets, and then they check 4 boxes, nothing could negatively affect my ability, my credit's okay, I haven't done anything wrong, etc. And then they sign it, and I get a $50,000 deposit from that purchaser, they're not likely to walk away. But I'll tell you, if they've committed fraud, they will lose that deposit. We had a home in McLean, Virginia that was in the McLean High School District. It was a brick and block 1950s rancher that was on the market for in the mid-7s, and a buyer came in, he was a contractor, represented on his financial information sheet that he had $100,000+ in the bank, and we're week and a half from settlement, I get a call from the buyer agent and they say, well, hey, we're not going to be able to make settlement. My client's going to need another 30 days. And I said, well, what's going on? Well, he just needs more time to get the loan through. I said, you're not answering my question. Why do we need more time? Well, he's got a couple things to work through on his business, and that's all. We just need another 30 days. I said, look, you got to tell me what's going on. We have a contract to close. Well, the agent told me, well, the buyer doesn't have enough money. I said, what do you mean they don't have enough money? They showed that they had $100,000 plus in the bank. Well, apparently they didn't have that money yet. So what do you mean they didn't have the money yet? Well, he's a contractor and it was accounts receivable. He didn't have it yet. And I said, you mean he reported to us at the time we accepted his offer he had cash when he didn't have the cash? And she said, I guess so. I said, you know, that's fraud. She said, yeah. I said, I got to talk to my client. I don't know if he's going to want it, what he's going to want here, but that your buyer's got to be ready to release that deposit to my client because they committed fraud. So I called my client and I said, look, they're insisting the buyer can perform, that he just needs another 30 days. I suggest that we take the deposit that's being held now by the title company and we have that then released to you personally, made out to you, and you receive the funds and deposit them in your account now in exchange for giving them 30 days. So it's a forfeited deposit if they don't settle. We'll all recognize that you got that 25 when we get to settlement, but you have the 25, it's in your account. If for some reason they can't settle, they don't get that money back. My client said, that's great, I love it. So I called the agent back and I said, look, my client does not want to sue your client. My client does not want to make this difficult. My client would like your buyer to buy the home. He's happy with the price. He's going to give you a little bit more time, but this is what we need. We need a check made out to my client and that he can deposit in his account. She got the check. I gave it to my client. My client deposited it. The buyer didn't settle in 30 days. Buyer lost a $25,000 deposit in that case. And my client was able to put the house back on the market with me. We sold it about 2 weeks later, and he made more money than he would have before, but went through some pain and got that deposit as a way of making things right. It's very, very, very important that, and this is my point in saying all of that, is it's very important that when we get a buyer who represents that they can do something, that they actually have the capability, if not that we have that they will share with us that they have the capability, and if for some reason they're not able to settle, that they pay for their misrepresentation. Makes sense, right? That's what you'd want as a home seller, protecting you. So fiduciarily, we provide care and obedience, and I put that word in my listing presentation. The rest of my team kind of chuckles at that, and sometimes home sellers do when I talk about it, because what is obedience? It's literally me telling you what I think and then doing what you ask. And I think that's a right way to approach any business relationship where you're hiring a professional. If that's an accountant or an attorney or whatever, you hired them, they work for you. The fiduciary duty in the state of Maryland, DC, and Virginia is the same as marriage when you sign an agency agreement. If I think you're falling down in something and I know better, I'm there to guide you, even if it has nothing to do with the home sale. Like, I'm supposed to be alert and aware of how I can protect you from problems. So I hold that very, very seriously. I'm accountable, I'm loyal. We all follow full disclosure at the Eric Stewart Group, which just means that it's important that you tell everything you know is wrong with your property, even when we sell it as is, and then you don't have any problems after the fact. Additionally, we treat all parties the same according to the Civil Rights Act of 1866, the Fair Housing Act of 1968, and the American with Disabilities Act of 1990, as well as any other addenda that have been added on in the meanwhile. And before you know it, your home will be sold. So timing is about entering the market at the correct time to capture the highest price. And now is a great time to go in because the demand is so good. And as I transition back into discussing where this market is heading in our closing portion of our Coffee with Eric Stewart today, again, I want to invite you to ask questions. I don't have any questions at this time, so please type those into the GoToWebinar control panel. There's a questions tab. I believe it's surrounded by red. And I'd like you to go ahead and just type any questions you have about the market or thoughts on what you think the market, the end game for this real estate market is going to look like. Take an opportunity to do that. For everybody that's here today, if you do not have a copy of the Market Ready Guide, we want to mail you a copy. I wrote this and rewrote it. It's good, it's very solid, and will help you understand some of the timing issues. It's got a nice chart in there to show you that. Also some questions you might want to ask a realtor before you hire one. That are 10 questions I created if I were going to be selling a property and I wanted to interview realtors, what would I ask? Okay. And then what to do with home inspections. We touch a little bit on downsizing your stuff, but if you have a lot of stuff, you may want to get a copy of the Market Ready Guide or the Right Sizing Guide. Both of these guides, we will mail them for you free, no cost to you. Just type your address into the questions tab where you are, and we'll mail them out to you in the next few days. They're two great guides, well received, well liked, and I always get a compliment on how well they're written. You know, it's not blah blah like a lot of books that we buy. It's like blah 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 blah, and they repeat the same thing a little differently and the same thing a little differently. No, I don't do that. You know, I'm pretty straightforward as it is. So request these. Type your information into the GoToWebinar questions tab, and we'll mail that out to you. This is our contact information. If you're at that point where you're ready to interview us as your potential realtor, call this number. Grace or Louise, one of our other team, will either take the call or call you right back. We'll get a time scheduled. You can also send any questions to AOC, which is just Agent on Call at Eric Stewart Group, and we will get back to you promptly, whoever's on call, and we'll take care of you. Our website, of course, is ericstewartgroup.com. And each week, we are bringing this Coffee with Eric Stewart forward for the next couple of months. And next Thursday, the 27th at 10:30, we'll be doing this again, but on pricing specifically. So we talked about timing today based upon what's going on. And the timing is this is the right time. Overall, normally I would say when the fireworks go up, the sales come down, and there'll probably be some attrition in demand in the summer because we'll start looking at going back into school, football, everything's opening up in the fall. So a lot of the dynamics of how the market undulates will come back into play, and we will see some slowing in the market later in the year. Will there be some pricing changes? Well, there's normally a drift in pricing of 3 to 4% from the peak each year until you get into the end of December. So you probably will see a little less frothiness as we sell in the fall. If you're not in a hurry to sell and you're still kind of looking at the timing of this, my professional opinion is the prices will climb again next year, and that they will climb by a fairly significant amount, considering, again, a 10% increase on an $800,000 home is $80,000, right? $500,000 home, it's 50 grand. This is not nothing. This is some serious money, and a lot of it is after tax, depending upon when you bought your property. I want to throw out something else to you as well. If you have been in your home for a long time and you have your capital gains exclusion, you have a period of time to move out and rent your property and then sell it if you wanted to, and still get the capital gains exclusion, right? You have to live in your home for what is at least 2 out of 5 years. So if you decided, well, I'm going to take Eric's advice here, I'm going to take the risk, and let's go ahead and move out for a couple of years, I'll rent it in hopes the market will continue to rise and then sell. So it's 2021 and you decide, okay, I'm going to wait until the spring of 23 and sell. You're still in range here with the rise to avoid the capital gains on up to $250,000 as a single, or $500 as a couple, okay? Any questions? Oh, good, we've got a lot. Okay. Okay, Robin. Okay, I'm not ready to sell now. What is your guess about the market next March, April? I would predict that prices will go up. If we don't see a further rise this year, I would predict a 15% increase, assuming that we see the rates staying where they are right now. Because again, a 15% increase in pricing, if you go up on 800,000 by say 120,000, 120 times 0.0421 at 3% is a $500 monthly difference to afford the same home, or annually 6,000. And what I'm seeing in terms of income, a lot of the buyers are overqualified to buy the home they're buying. Like, they could afford to go to 1.5 and they're buying 1 million, or they could afford to buy 800 and they're buying 500. So there's still a conservative bent. I think there's still fear, and we're going to get to an irrational exuberance. We're not there yet. We're going to get to that. So I predict a 15% rise, Robin, between now and next spring's market. So by the time we get to selling in late February or March, that's what I think will be happening. So good question. Jerry, thank you for offering to mail the guides to. Okay, great. Okay, you like all the books, Robin, that's fine. And I don't know if we have your address already. Great. If not, please type that in here and we'll get those out to you. Jerry, we'll send out to your property in Alexandria. We'll mail that, both of the guides to you there. And Patricia, great. Yep, we'll send out both copies of those to you in Fairfax Station. Do you think the Alexandria market will be stronger than the rest of the area for the next few years because of the Amazon HQ coming? The answer is yes. We are seeing executives buying in McLean and also in Potomac and Bethesda and Chevy as well. So it's going to have an impact across the region, more so as they continue to develop and finish their headquarters. We have Amazon Web Services out in Ashburn, and they had maybe 8,000 employees here in this area before they announced the development. I think they're up to something like 12 or 13,000 now. Over the last, they're adding 500, 600 every year, and Amazon's doing a lot of different things, right? They're doing some new supermarket concept, I think some kind of fresh and go kind of a thing where you order and you go pick up all your groceries. They're really expanding their presence and trying to streamline the way people buy in the same way that they did with Amazon for purchasing things. So yeah, the answer is yes, prices will continue to rise in Alexandria, and probably more so in what we call, for those of you who don't know, there's a section of Alexandria that's right there that's called National Landing now, that's pretty much right by Crystal City, Alexandria, and Arlington. So, and Wayne asks, and that price includes condos. So Wayne, I do think the condos will jump, okay, because this was something I talked about on my radio show and on a previous webinar. We're in I call it a double spread opportunity. It's a rare opportunity for a home buyer to be able to buy a condo at a discount, probably for the next few months, while home prices have increased as much as they have. So prices on condos have been stagnant because of COVID. And so if a condo, like I sold a condo 2 weeks ago for $864, it appraised for almost $900. We just got the appraisal back. That condo was on the market for 17, 18 days, and it was gorgeous. And my client got a little discount on it. They were asking $880, which I also thought was a good value, but we got it to $864, down 15. And they're going to sell their home for $100 more than they would have. They're buying a condo at a little bit of a discount. And Wayne has a condo, so we chatted about this previously, which is why he's asking the question. And I've recommended to Wayne that he wait, because as the market jumps, like if prices on singles jump another 15%, the condos can't do anything but go up. There's just going to be too much demand for what's there. Okay, so let's see what we got here. Robin, okay, thanks, Robin. I got your address there, and then David asked a question. Okay, you're interested in coordinating. David, let's talk, and I would say probably I'm the right person to start that conversation, and I can think of one other person I'd want to bring in on that in your assisted living facility purchases. Would you mind shoot me an email at eric@ericstewartgroup.com? I think I've got your email as well, so I'll circle back with you too, and we can take it from there. Alrighty, and And Kelvin, thank you. Okay, I've got your information here. Yep, we'll mail you a copy of the Market Ready Guide. Wayne, good. All right, thank you, sir. David, my pleasure. Okay, good. So I think we're going to double. I think that's where we're going to end up. Whether there's some unforeseen event that causes it to stagnate, or we have a couple years of sort of flatlining. Remember, 6 years is a long time for prices to go up, and we saw 1980 to 85 prices doubled, right? Didn't happen in a year. And sorry, 85 to 90, excuse me. And then again, from like 96 up to 2000, we saw prices creeping, and then boom, they jumped, and they jumped further. By 2003, I couldn't believe how prices had gone. And I gotta say, I'll tell you my personal stories. Like, I did some investing back in 2003, bought some condo-tels. These are like almost like a condominium in Hawaii, in an island called Molokai, where my grandfather had been he was the head of the Shriners Hospital in Oahu, and he was an orthopedic surgeon. He used to go to Molokai and take care of the lepers whose bones were broken and set them, and then he would go back to Oahu. So I always wanted to go to Molokai. I've never been, but I ended up buying a couple things, and I bought them for 100 and a quarter and sold both of them for 250 18 months later. That's how dramatic the upside was from 2003 to late 2004. And then I bought another condo in Arizona. I want to say I paid $400,000 for a condo. It went up to $650,000, but I couldn't sell it because it wasn't delivered yet. And by the time the market was correcting, I ended up selling it for a little over 500, still made a profit. I then became a long-term landlord on another property that I settled in 2006, and only sold that last December, and for less than what I paid for it. So timing when you buy and how the market will shift is it's precarious at times. But we're early in the cycle still, and I think the momentum is intact, and the promise by the Fed to keep rates low, and the increase in inflation across the cost of wood, copper, et cetera, I think we're going to see it double. So my personal opinion. We'll see what happens, and you guys come back and make fun of me if I'm wrong, okay? But all right, so hey, look, I'm going to turn on my camera for just a second so we get a chance to see me, and can just wave at y'all. It's a pleasure to have been with you today. If you guys don't have any other questions for me, I'm going to adjourn, and again, we'll get these guides out to you, everybody that's requested one. If you still would like us to mail you a copy, you've got to, I'll take another couple minutes just waiting here. Just type in your name and address and your phone number. We want to make sure we do get back in touch with you to confirm you've received it. The right sizing guide is a particularly good one, as I've worked with a lot of communities that are continuing care retirement communities, whether it's independent assisted or memory care. There's a process that I take my clients through to make that overall transition very smooth. So you can get that information in the right sizing guide. You can also request a copy of that, or just go online and download a copy, or have a link to it. So, all right, so it's been a pleasure, and I wish you all very well. Great day to you, and again, join us again next week. I'll be back at that time. We will talk specifically on pricing, and how do you price a home well to the market. What are the 6 considerations for pricing any property, and how do we walk that through with our home sellers? Okay. All right. Well, y'all take care, and have a great afternoon. Okay. Hey, David, thank you very much for reading that. Appreciate that. Good. All right. Pleasant day to everybody. Bye now.